Most people believe their financial life is shaped by hard work, smart choices, and maybe a little luck, but what if a quiet institution you never voted for has more influence over your paycheck, your mortgage, and even your job security than anything else? What if the rise and fall of your savings balance is not random, not accidental, but the result of deliberate decisions made behind closed doors? Today's story challenges the idea that money is purely personal and asks a more unsettling question: who is really in control of your financial destiny? Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. To understand that question, we need to travel back more than a century, to a time when the United States did not even have a central bank. In the early 1900s, America's financial system was chaotic. Banks failed often, people lost their savings overnight, and panic spread quickly because there was no central authority to calm markets. The most terrifying moment came in 1907, when a financial panic caused banks to collapse one after another, forcing wealthy financiers like J.P. Morgan to personally organize rescues. That crisis planted a dangerous thought in Washington: what if next time no one stepped in? Behind the scenes, a small group of bankers and politicians began discussing a radical idea. They believed the country needed a central institution that could act as a lender of last resort, control the supply of money, and prevent future panics. In 1910, a secret meeting took place on Jekyll Island, Georgia, where powerful figures quietly drafted the blueprint for what would become the Federal Reserve. The secrecy alone should make you pause. Why would something meant to protect ordinary people need to be planned in the shadows? In 1913, the Federal Reserve Act was passed, and the Fed was born. It was presented as a stabilizing force, a guardian of the economy that would smooth out booms and busts. On paper, its mission sounded simple: maintain stable prices and promote maximum employment. But buried in that simplicity was enormous power. The Fed could now influence how much money existed in the economy, how expensive it was to borrow, and how fast the economy could grow. Most Americans barely noticed, yet their financial future had just changed forever. At first, the Fed's role seemed distant and technical, something only bankers cared about. But over time, its decisions began quietly shaping everyday life. Interest rates moved up or down, credit became easier or harder to get, and asset prices responded. A farmer buying equipment, a family buying a home, and a business hiring workers were all reacting to signals sent by this central institution. The Fed did not knock on doors or issue commands, yet its influence spread everywhere, like gravity pulling unseen strings. Then came the Great Depression, the ultimate stress test. The stock market crash of 1929 spiraled into massive unemployment and widespread poverty. Many historians argue the Fed made critical mistakes, allowing the money supply to shrink when it should have expanded. Banks failed by the thousands, and ordinary people paid the price. This was a turning point that raised a disturbing question. If the Fed was created to prevent disasters, why did one of the worst economic collapses in history happen under its watch? The response to that failure reshaped the Fed's identity. Over the following decades, it gained more tools, more authority, and more independence from political pressure. The idea was that unelected experts could make better long-term decisions than politicians worried about elections. That sounds reasonable, until you realize how insulated those experts became. When the Fed adjusts interest rates, Congress does not vote, and citizens do not get a say. Yet those decisions ripple through every household budget in the country. To see how this affects you, think about interest rates as the price of money. When the Fed lowers rates, borrowing becomes cheaper. Suddenly, mortgages look affordable, credit cards feel manageable, and businesses are eager to expand. Jobs increase, optimism grows, and asset prices rise. But there is a catch that rarely gets attention. Cheap money encourages debt, and debt always comes with risk. The good times feel natural, but they are often artificially fueled. Now imagine the opposite. When inflation rises and the Fed decides to increase rates, everything tightens. Mortgage payments jump, new loans slow down, and businesses cut back. Layoffs follow, and fear replaces optimism. From the outside, it feels like the economy just turned against you. But in reality, a policy decision flipped the switch. The same institution that made borrowing easy now makes survival harder, all in the name of stability. This pattern repeated dramatically in the early 2000s. After the dot-com crash, the Fed slashed interest rates to stimulate growth. Money flooded the system, and housing prices soared. People who had never owned homes suddenly qualified for mortgages. It felt like a golden age of opportunity, but beneath the surface, risk piled up. Adjustable rate loans, complex financial products, and overconfidence created a fragile structure waiting to collapse. When the housing bubble burst in 2008, the consequences were devastating. Millions lost their homes, retirement accounts were wiped out, and unemployment surged. Once again, the Fed stepped in, this time on an unprecedented scale. Interest rates were pushed near zero, and trillions of dollars were injected into the economy through programs most people had never heard of. The goal was to prevent total collapse, but the side effects were enormous. Here is where the story takes a controversial turn. While the economy stabilized, wealth inequality exploded. Asset prices recovered quickly, benefiting those who owned stocks and real estate. Wages, however, lagged behind. If you owned assets, you got richer. If you relied on a paycheck, you struggled. The Fed's actions may have saved the system, but they also deepened the divide between those with capital and those without it. Fast forward to the pandemic era, and the pattern becomes even clearer. In response to economic shutdowns, the Fed unleashed massive stimulus. Money supply growth reached levels never seen before. At first, it felt like relief. Markets soared, unemployment dropped, and spending rebounded. But then came inflation, quietly at first, then all at once. Grocery bills climbed, rent surged, and savings lost value in real terms. When inflation became impossible to ignore, the Fed reversed course aggressively. Interest rates rose at the fastest pace in decades. Home buyers were priced out almost overnight, businesses faced higher costs, and layoffs returned to the headlines. For many people, it felt like whiplash. One year, money was easy. The next, everything was expensive. This cycle is not accidental. It is built into how the system operates. What makes this even more unsettling is how little transparency most people experience. The Fed communicates through press conferences and technical language that feels inaccessible. Decisions are framed as necessary and unavoidable, yet the trade-offs are real. Fighting inflation often means higher unemployment. Stimulating growth often means higher future prices. Someone always pays the cost, but that reality is rarely emphasized. Supporters argue there is no alternative. They claim that without the Fed, the economy would be even more unstable, subject to wild swings and frequent panics. Critics respond that concentrated power over money inevitably benefits those closest to it. Banks, financial institutions, and asset holders respond first to policy changes, while ordinary workers feel the effects later, often negatively. This debate has never been resolved, and it likely never will be. Consider a simple example from everyday life. Imagine you are planning to buy a home. 1 year ago, a mortgage payment fit comfortably within your budget. Today, the same house costs hundreds of dollars more per month because rates changed. You did nothing wrong. Your income did not suddenly become irresponsible. A policy decision shifted the rules of the game, and you must adapt or step aside. The same applies to savings. When interest rates are low, money in the bank earns almost nothing. Inflation quietly erodes its value. People are pushed toward riskier investments just to keep up. When rates rise, savers finally earn more, but borrowers suffer. The Fed's balancing act creates winners and losers depending on timing, position, and access. This brings us to a deeper question: is the Federal Reserve controlling the economy, or is it reacting to forces beyond its control? The honest answer is both. It responds to data, but its responses shape future behavior. Expectations change. Markets anticipate moves. People adjust spending and investing decisions based on what they think the Fed will do next. In that sense, perception becomes reality. Historically, every attempt to fine-tune the economy has produced unintended consequences. Each crisis leads to new tools, more complexity, and greater reliance on central intervention. Yet the fundamental problems remain. Debt levels grow, bubbles form, and corrections become more painful. The system survives, but at an increasing cost. So where does that leave you? The first takeaway is awareness. Understanding how the Fed operates helps you interpret economic news and personal financial changes more clearly. When rates move, it is not random. The second takeaway is adaptability. Building flexibility into your finances, such as emergency savings and manageable debt, reduces vulnerability to policy shifts. The third takeaway is skepticism. Question narratives that present economic outcomes as inevitable rather than the result of choices. The unresolved warning is this: a system that depends on constant intervention may be more fragile than it appears. As debt and expectations grow, the margin for error shrinks. Whether the next crisis comes from inflation, deflation, or something entirely new, the decisions of the Federal Reserve will again shape the outcome. The question is not whether it will affect your life, but how prepared you are when it does. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.